Welcome to Tech Money Madness, your daily U.S. stock market podcast, May 19th, 2026.
Hey, everyone!
And if you are looking at the tape today, you are basically looking at the ultimate market split screen. It's wild.
Totally. It's a completely divided market right now.
Right, because on one hand, you've got the tech sector practically popping champagne, acting like it's 1999 all over again.
Yeah, they're having a great time.
But then, the actual consumers buying the goods are staring down this gritty, almost 1970s style inflation crisis. So today is a deep dive into that chaos. We're going to give you the shortcut to making sense of it all.
And you really see that tension playing out tick for tick in the indices today. The broader market is just essentially paralyzed.
Yeah, totally flat.
Exactly. The S&P 500 and the Dow Jones Industrial Average are sitting completely flat, just entirely range-bound.
Nobody wants to make a move.
Right. But then you look over at the Nasdaq Composite, and it's actually edging slightly higher. It's like the tech-heavy index is just completely divorced from the broader economic reality.
It really is. Like when I look at the broader market today, it feels like a driver sitting at a yellow light.
Oh, that's a good way to put it.
Yeah, with their foot just hovering over the brake pedal. Because nobody wants to make a sudden aggressive move until they see what the two biggest heavy hitters on the planet are going to do next.
And we are, of course, talking about Nvidia and the Federal Reserve.
Exactly. Slamming on the brakes right now means you might miss the green light of this massive tech earnings beat. But accelerating means you risk running a red light straight into a macroeconomic wall.
Yeah, and that wall is looking pretty solid right now.
So let's actually examine that macroeconomic wall first.
Yeah.
Because that is the physical road we are all driving on. The broader market is holding its breath because, this data we're seeing is acting like a pressure cooker for the whole consumer economy.
It really is.
I know the sentiment out there feels uneasy for a lot of you listening, but lay out the actual numbers for us. Because we just got the latest inflation data, and it is stark.
Yeah, the numbers are basically flashing red. The consumer price index, the CPI, has risen to 3.8%.
Right, which is the headline number everyone looks at.
Exactly. That's what makes the news. But the underlying mechanism, the number that really dictates where we go next, is the producer price index, the PPI.
Okay, what did that do?
That just spiked by a massive 1.4% month over month.
Wow. Okay, let's pause on that 1.4% jump for a second. Because if you're out there wondering why your portfolio is trading sideways today, this is why.
Yep, it's the wholesale cost.
Right. The market knows these wholesale costs are about to hit your wallet. Because the PPI measures the cost for the companies that are actually making and shipping the goods, right?
Exactly. It's the factory door price.
And the CPI is what you and I actually pay at the cash register. And companies generally don't just, absorb a 1.4% monthly jump out of the goodness of their hearts.
Definitely not. They pass those costs directly onto the consumer.
Right. So a hot PPI today basically guarantees a hot CPI tomorrow.
Mathematically, yes. And the sources point to the specific drivers of this wholesale spike, and I gotta tell you, none of them are easily solved.
What's driving it?
Well, energy costs are surging, supply chain bottlenecks are compounding again, and, the ongoing conflicts in the Middle East are severely disrupting commodity supplies.
Because it's not just a theoretical economic model, right? We're talking about massive physical cargo ships having to literally turn around in the ocean to avoid the Red Sea.
Right, taking an extra 3 or 4 weeks to sail all the way around the Cape of Good Hope.
Yeah, and they're burning thousands of tons of extra diesel. They're paying these skyrocketing insurance premiums.
Exactly, and that creates immediate supply chain bottlenecks, which of course drives up the cost of raw materials and the energy needed to run the factories.
Which brings us perfectly to the Federal Reserve's massive dilemma. Because Kevin Warsh has just been confirmed as the next Federal Reserve chair.
Right.
And he is stepping into this scenario where inflation isn't just sticky, it's actually reaccelerating at the very foundational level of the economy.
Yeah, it's a tough spot. And traders looking at this data are interpreting it as a direct catalyst for an interest rate hike.
Okay, when?
Market is now actively pricing in a rate increase by July 2027.
Wait, July 2027?
Yeah, that's what the futures are saying.
Okay, the timeline on this rate hike is honestly breaking my brain a little bit. If inflation is burning hot right now, like today, at 3.8%, and wholesale prices are spiking as we speak,
Right.
why on earth is the market betting on a rate hike a whole year away in July 2027? Like, is the Fed just asleep at the wheel here? Or are traders completely mispricing the urgency?
Well, it comes down to how markets aggregate risk versus how central banks actually operate. I mean, the market isn't claiming the Fed shouldn't act until July 2027.
Okay, then what are they saying?
Traders firmly believe that the Fed really wants to avoid breaking the labor market. So they're going to hold rates steady for as long as humanly possible, basically praying that these supply chain shocks are temporary.
Ah, I see.
So that July 2027 date, that is the market's mathematical breaking point. It's the moment where the bond market believes the new Fed chair, Kevin Warsh, will have absolutely no choice left but to hike if the data doesn't cool down.
Got it. So it is just a massive game of chicken between global supply chains and central bank policy.
Exactly. A huge game of chicken.
Wow. So
Yeah.
the broader market is sweating out this macro game of chicken, terrified of a squeezed consumer.
Yeah.
But then you look over at the Nasdaq.
Yeah, totally different world.
Right. They are operating in an alternate universe, the AI universe.
Right.
And one company is sitting at the dead center of it, basically holding the entire stock market sentiment on its shoulders.
Nvidia. Their upcoming earnings report is the gravity well of the entire financial system right now.
I really want to talk about the expectations here
Mm-hmm.
because they are almost incomprehensible for a company of this physical size. Like, give us the baseline. What exactly is Wall Street demanding from Nvidia in this report?
Okay, so analysts have modeled out $1.76 earnings per share on $78.67 billion in revenue.
That's billion with a B.
Billion with a B. And to put that scale into perspective, that represents 117% year-over-year growth for EPS and 79% year-over-year growth for revenue.
Wait, 117% EPS growth.
Yep. It's massive.
I mean, I look at those numbers and I just see a toll booth on the only bridge out of town.
Right.
Like everyone, every tech giant, every government, they all have to cross that bridge to get to the AI future.
And Nvidia gets to name their price.
Exactly. But the sources we're looking at highlight that Wall Street isn't just looking at the top and bottom line anymore. Like, they're scrutinizing cash returns, competitive threats, and I think most importantly, margin sustainability.
Oh, margin sustainability is the ultimate stress test here. Because when you print 117% EPS growth, your profit margins are expanding massively because you have total pricing power.
Nobody else can do what you do.
Right. But as supply chains catch up and competitors finally bring viable chips to the market, maintaining those sky-high margins becomes, honestly, the single hardest feat in corporate finance.
Right.
Which ties directly to the timing of their new hardware rollout, the Vera Rubin architecture.
Okay, let's unpack this Vera Rubin architecture, because the name gets thrown around a lot in the press, but the actual mechanism of why it protects NVIDIA's margins is rarely explained.
Yeah, people just think it's faster.
Right, but it isn't just about raw processing speed, is it?
Speed is a given, but the real bottleneck in data centers right now is physical power and cooling.
Ah,
You literally cannot pipe enough electricity into these buildings to run the current chips. And even if you could, they would melt.
right, they run insanely hot.
So the Vera Rubin architecture is engineered to deliver significantly more compute power per watt of electricity. It completely changes the operating expense equation for the data center.
So it's got efficiency.
Exactly. If NVIDIA can smoothly transition their major clients to this next, more power-efficient, more expensive architecture before competitors can match their current generation, they lock in those massive margins.
Wow.
It's all about moving the technological finish line just as the competition thinks they're finally in the race.
That is wild. I mean, Wall Street is treating NVIDIA like a company that can sprint a marathon. They just delivered 117% growth, and the market is essentially demanding they do it again, but faster.
Pretty much.
But at nearly $79 billion in revenue, hasn't the easiest phase of this growth already been priced into the stock? Like, how long can these margins defy gravity before the law of large numbers just takes over? You can't double $79 billion with the same ease you double $1 billion.
You really can't. The law of large numbers dictates that a massive entity cannot continue to grow at startup speeds without a structural change in the global economy.
So why is the stock still edging higher?
Well, the counter-argument keeping it up is that NVIDIA's margin stress test isn't just about competitors making slightly cheaper chips. The actual math equations these chips are being asked to solve are fundamentally changing.
Okay, which brings us to a massive pivot in the tech narrative from our sources today. We are moving away from simply building the foundational AI models, right?
Right.
Into this new phase called deploying agentic AI workloads. And this shift is completely scrambling who gets the massive hardware contracts over the next 5 years.
It is a massive shift. The market for these agentic AI workloads is projected to explode from $29.3 billion in 2025 to $131.5 billion by 2030.
Wow.
That is a 35% compound annual growth rate.
Let's define that for the listener really quick, because the 35% CAGR is just staggering.
It's huge.
It means this specific subsector of AI is growing by 35% every single year, compounding on top of itself for the next half-decade.
Yep.
And the sources point out two primary beneficiaries capturing this specific growth, AMD and Intel. Which is surprising, right? Because for the last 2 years, all we've talked about are Nvidia's GPUs.
Nvidia's been the only game in town.
Yeah. So why are AMD and Intel suddenly jumping into the spotlight for agentic AI?
It really comes down to the physical difference between a GPU, a graphics processing unit, and a CPU, a central processing unit.
Okay, break that down for us.
So the previous phase of generative AI was all about training the models. Think of a GPU like a massive symphony orchestra. Thousands of simple instruments playing at exactly the same time to produce one giant wall of sound.
So parallel processing.
Exactly. That parallel processing is perfect for ingesting the entire internet at once to train a language model.
But agentic AI doesn't need a wall of sound.
No, agentic AI needs a solitary, brilliant detective. These are autonomous agents designed to execute multi-step tasks across different software applications. They have to reason sequentially.
Live step by step.
Right. Like, if the client emails this request, then check the inventory database, and if the inventory is low, then draft a purchase order, but wait for a human manager's approval.
Oh, I see.
That is complex sequential logic. If X, then Y, then Z.
And CPUs are designed specifically for that kind of sequential reasoning.
Exactly.
So we've moved from the phase of building the massive digital library using NVIDIA's GPUs to the phase where we are basically hiring millions of autonomous digital managers to work inside the library.
That's a great analogy.
And those managers require an entirely different kind of digital office space. They require advanced server CPUs, which is the historical home turf of AMD and Intel.
Right. And AMD is already capturing this massive wave of growth through enterprise market share gains. Like, they are going out to massive corporations and winning contracts based on pure technological performance in the data center.
Okay, but I'm looking at Intel's strategy and the sources, and it feels entirely different.
It is very different.
Because while AMD is out there winning enterprise contracts, Intel is relying heavily on sovereign-backed foundry deals and government support.
Yeah, they are leaning hard into that.
Which makes me wonder if Intel is leaning on government lifelines and geopolitical fears rather than pure technological superiority in the open market. Is that actually a sustainable business model? Or is it just a massive geopolitical safety net?
Well, in the current macroeconomic climate, a geopolitical safety net might actually be the strongest economic moat in existence.
Really?
Yeah, because semiconductors are no longer just consumer goods, they are critical national security assets. Governments around the world have realized that relying on a single geographic bottleneck for chips is a massive existential vulnerability.
Oh, for sure.
So Intel's strategy leverages that exact fear. They are positioning themselves as the domestic, sovereign, secure option.
Got it. It's basically Intel saying, look, we might not have the absolute fastest car on the track today, but we own the only racetrack inside your country's borders.
Exactly. For sovereign governments staring down those supply chain bottlenecks and Middle East conflicts we discussed earlier, security of supply trumps absolute peak performance every single time. Having the backing of the U.S. and allied governments ensures continuous capital injection and guaranteed contracts.
Man, all of these macroeconomic fears on one hand and these agentic AI dreams on the other have just created a fascinating daily tape today.
Oh, the tape is wild today.
It is forcing investors to actively hunt for hidden value and safe harbors, and they are completely ignoring the middle of the market. Let's actually break down the day's specific stock movements because it perfectly reflects everything we just unpacked.
Let's do it.
So the top gainers today are Nvidia, AMD, and Intel. The AI hardware boom is just driving all the green.
Yeah, capital is flowing relentlessly toward the physical picks and shovels of the AI build-out.
But look at the top losers today. Apple, Netflix, and Spotify. And the most active stocks by volume overall were Nvidia, Apple, and Microsoft. I really want to zero in on Apple being a top loser because there is a massive paradox sitting in the middle of their valuation.
Yeah, there is.
According to the analyst arguments in our sources, the broader market is severely undervaluing Apple's services segment. Like they argue that this software segment alone could add an additional $13 per share to Apple's stock price if it were valued correctly.
It is a classic valuation mismatch driven by historical categorization. I mean, Wall Street looks at Apple and fundamentally sees a hardware company.
Right, they see iPhones.
Exactly. They see a company that sells iPhones, iPads, and MacBooks. And hardware companies historically receive lower valuation multiples, maybe 15 or 20 times their earnings, because hardware is cyclical.
Yeah, you have to convince a consumer to go out and buy a brand new expensive piece of glass and metal every 2 or 3 years.
Right. But software as a service, the SaaS companies, they operate in a completely different financial reality.
Because it's recurring.
Exactly. SaaS companies get valued at 30, 40, sometimes 50 times their earnings because their revenue is sticky. It comes in every single month, whether they launch a new product or not.
So Wall Street is getting it wrong.
Well, investors are treating Apple like a hardware company dealing with slowing iPhone sales, while completely discounting the fact that they have built one of the most profitable, recurring revenue software ecosystems on the planet with the App Store, iCloud, and Apple Music.
Right.
If you ripped the services segment out of Apple and took it public as a standalone SaaS company, the market would value those revenue streams at a massive premium, which translates to that hidden $13 of value per share.
Okay, but if the math is that obvious and the hidden value is truly $13 per share, why is the market completely blind to it today? Are traders just so mesmerized by the shiny new AI chips from Nvidia and AMD that they're ignoring a massive software value right in front of them?
Markets are driven by narratives in the short term. Right now, the dominant narrative is AI infrastructure, while the dominant fear is the squeezed consumer.
Back to the inflation.
Exactly. Capital is actively draining out of consumer discretionary and subscription services. This brings us full circle to that 3.8% CPI inflation and the 1.4% wholesale price jump. If everyday people are paying significantly more for groceries, gas, and energy, they are going to tighten their belts.
Yeah, they have to.
So they might cancel a secondary Spotify subscription, downgrade their Netflix plan, or, delay upgrading their iPhone for another year.
And Wall Street sees that consumer squeeze coming. So they are selling off consumer tech and rotating that money into two extreme ends of the market. It's a classic barbell strategy.
A total barbell strategy. On one end of the barbell, they buy the high-growth AI infrastructure, Nvidia, AMD, Intel, because enterprise spending on AI seems immune to consumer inflation right now.
Right.
And on the other end of the barbell, they buy ultra-safe havens.
Which perfectly explains the major sector trend triggered by all this tech volatility. The utility sector is suddenly attracting massive attention.
Utilities, yeah.
Our sources highlight the Vanguard Utilities ETF, ticker symbol VPU. Investors are just piling into this specific ETF as a safer alternative to broad S&P 500 index funds. They want to drastically reduce their exposure to the wild swings of the mega-cap tech stocks.
Well, utilities are the ultimate defensive play against a macro pressure cooker. They provide steady, reliable dividends, and they are almost entirely insulated from consumer discretionary spending habits.
That makes sense.
Right. Because you might delay buying the new iPhone because inflation is biting, but you are not going to shut off your home's electricity or water supply.
Definitely not.
When tech valuations get incredibly lofty and the threat of a 2027 rate hike looms, capital preservation becomes the priority. So the smart money seeks out the boring, reliable yield of a utility.
Buying utilities during an AI boom feels totally counterintuitive, though. It's like selling water to the guys holding the shovels during a gold rush. It isn't glamorous, but mathematically, it protects your downside.
Exactly.
Well, let's pull all of these threads together, because we've covered the entire spectrum of the market today. If you're going to take away the core lessons from this deep dive, here is the synthesis. First, the overarching tension throttling the broader market is inflation. That 1.4% monthly jump in wholesale prices means costs are about to hit the consumer, keeping the threat of a 2027 rate hike by new Fed Chair Kevin Warsh incredibly real.
Yep.
Second, despite those macroeconomic fears, tech exuberance is alive and well, anchored by Nvidia's monumental expectations for 117% EPS growth and the rollout of their power-efficient Vera Rubin architecture.
And beyond NVIDIA, the fundamental nature of AI is shifting toward those agentic workloads we talked about. That complex sequential reasoning requires advanced server CPUs, creating a 35% compound annual growth rate gold rush for AMD and Intel.
Right. And finally, the market's reaction to this tug-of-war is a massive defensive pivot. Capital is fleeing consumer subscriptions like Apple and Netflix due to inflation fears and hiding out in boring safe haven utilities like the VPU ETF.
It's quite the rotation.
It is. But I want to leave you with a final provocative thought to ponder. Something that connects the two extreme ends of this barbell strategy we've mapped out today. We established that the agentic AI market is growing to a staggering $131.5 billion by 2030, right?
Right.
And that requires deploying millions of new server CPUs from AMD and Intel alongside Nvidia's GPUs. Well, the physical electricity required to power those millions of new AI servers is going to be absolutely astronomical.
Oh, without a doubt.
So if investors are rotating into the utility sector today merely as a safe, boring hedge against tech volatility, is it possible that the boring old utility sector is actually poised to become the next massive growth sector? Simply because they are the only ones who can generate the electricity needed to keep the AI dream alive.
That's a fascinating way to look at it.
It's a wild thought to leave you with as you look at your portfolio. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.